Why does the market always crash the second you buy? Be honest, you study the chart. You wait for the perfect moment. You finally click buy, and suddenly the market acts like it took that personally. It drops. Hard. Your profits disappear. Your confidence disappears. And now you're staring at your screen like you just triggered a global financial crisis. So, is the market against you? Or are you making one brutal mistake almost every beginner makes? Let's talk about it. The common mistake is ignoring market context. If you've ever felt like the market only goes down when you enter, you are not crazy. But the truth is even more dangerous than bad luck, because most people don't lose money because the market hates them. They lose because they enter at the exact moment everyone else feels safe. In the market, the moment you feel safest is often the moment risk is highest. Today, I'll show you why this happens, why it feels personal, and how smart traders avoid becoming exit liquidity. Let's start with the emotional truth. You don't usually buy when the market is boring. You buy when it looks exciting. You buy after a big green candle, after the breakout, after the influencer says this is just the beginning, after the news becomes bullish, after your fear turns into FOMO. And that's the trap. Because by the time the average person feels confident enough to buy, the smart money may already be preparing to sell. When a movie becomes popular, everyone wants a ticket. But in markets, when everyone suddenly wants in, that often means the move is already crowded. You're not early. You're not even on time. You're often the late buyer giving early buyers their profit. There are a few brutal reasons this happens again and again. 1. You buy confirmation too late. Most people wait until the chart looks obvious. Thousands of other traders see the same thing. And markets love to punish obvious entries. The breakout looks clean. The candle looks strong. The momentum looks perfect. Then suddenly, reversal. Why? Because price doesn't move to reward the majority. It moves where liquidity is. You enter emotionally, not strategically. A lot of people don't buy because their system told them to. They buy because they're tired of watching price go up without them. That means the entry is emotional from the start. And emotional entries usually happen far away from good risk to reward levels. You're buying high, hoping for higher. Big players need someone to sell to. This is the part beginners hate hearing. When large traders want to exit, they need buyers. And who becomes the buyer? Usually, the excited late crowd. So price gets pushed up, people chase it, and then the dump begins. Not because the market saw your order and panicked, but because you entered in the same zone where many inexperienced traders also enter. The real enemy is psychology. The market is not attacking you. Your psychology is setting you up. Price rises. You watch from the sidelines. You feel regret. Then fear of missing out grows stronger. Then you convince yourself, no, this time it's definitely going higher. So you buy. But the second you enter, something changes. Now you are emotionally attached. Every tiny red candle feels massive. Every pullback feels like betrayal. Every dip feels like the start of a crash. And suddenly, what was just normal volatility becomes unbearable. This is why many traders say, the market dumped because I bought. But often, the market didn't do anything unusual. It just stopped going straight up for 5 minutes. Your emotions did the rest. Imagine a stock or crypto asset rises from 100 to 130. At 110, people are skeptical. At 115, some smart traders enter. Imagine a stock rises from 100 to 130. At 120, more attention comes in. At 125, social media starts screaming. At 130, you finally buy because now it looks strong. But from the market's perspective, you're entering after a 30% move. That means your upside may be limited, your stop loss may be wide, and your risk is much higher than it was for the earlier entries. Then price falls from 130 to 122. That's not unusual. That's a pullback. But for the late buyer, it feels like disaster. So how do you stop this from happening? First, stop buying excitement. Excitement is expensive. Best entries often feel uncomfortable, boring, or even slightly scary, because value usually appears before the crowd feels safe. Second, have a plan before price moves. Don't decide to buy after the giant green candle. Decide in advance. Where is my entry? Where is my stop? Where is my target? What setup am I actually trading? Third, accept that missing a move is better than chasing a bad one. This is huge. A missed trade costs your ego. A bad trade costs your capital. Protect your capital. Scale in instead of going all in. If you always enter with full size at one emotional moment, every move against you feels catastrophic. Scaling in reduces pressure and helps you think clearly. Learn to wait for pullbacks, not headlines. Most beginners buy the story. Experienced traders buy the structure. The market goes down after you buy, not because you're cursed, but because you often buy at the same moment weak hands become most emotional. And the market feeds on emotion. It punishes greed. It punishes impatience. It punishes the need to be in every move. Your biggest enemy is not manipulation. It's the part of you that wants instant validation. Because the market doesn't care about your timing, your feelings, or your hope then. It only responds to orders, liquidity, and behavior. And if your behavior looks like the crowd, you'll often get the crowd's result. So next time you feel like saying, the market only drops when I buy, ask yourself a better question. Did I buy because the setup was good, or because the candle was exciting? That one question can save you a lot of money. If you enjoyed this video, subscribe for more trading psychology and market lessons. What's the worst trade you ever entered right before a dump?